Dear viewers, my name is Dr. Sharat Khandaga, and today we are going to discuss about non-bank financial institution in our lecture. So, non-banking financial institution in Australia, which basically includes building society, credit union, finance companies, and there are two other institutions which is not included in here, which are the superannuation companies and insurance companies. However, for our lecture today, we are only going to discuss about the building society, credit unions, and finance companies. The non-banking financial institution, these institutions are relatively small compared to the big commercial banks that dominate the Australian financial sector. Whilst they hold more than $187 billion in their asset, the growth rate of their asset has been lagged behind that of the big commercial banks. Now, in this slide, it shows the assets of the financial institutions in Australia from 1990 till 2009. If you look at this slide, you can see the total asset size of the financial institutions in Australia, which includes the Reserve Bank of Australia. In 1990, their asset size was $25.7 billion, and in 2009, it became $111.9 billion. So, there is a growth, but which is not an extraordinary growth for the RBA Australia. The same goes for the permanent building society, credit cooperatives or unions, and paid for the finance companies. If you look, the permanent building societies, their asset size is $22.9 billion in 1990. For the credit cooperatives, their asset size is $8.5 billion, and the finance company, it is $55.4 billion in 1990s. However, their asset became $21.5 billion, $46.0 billion, and $119.7 billion in 2009. So if you look into the size of their asset from 1990 till 2009, the growth is not that enormous. However, if you look the size and the growth of assets of commercial bank other than the RBA, you will find some fascinating information. For example, if you look the size of the banks in 1990s, it was $325 billion. However, in 2009, it became $2,587.1 billion. Now, in 2018, the total asset size of Australian commercial bank includes more than $3,000 billion, which is $3 trillion. So the next slide will be talking about three different types of non-banking financial institutions which are operated in Australia, which includes permanent building society, credit union, and finance company. So the number one is the permanent building society. Permanent building societies, they are the deposit taking institution or authorized deposit taking institutions, ADI. The building society has operated in Australia since 1850s, and the building societies are regulated by the APRA, which is Australian Prudential Regulatory Authority, and they are regulated same way as banks. So if you look into the asset side of the permanent building society, you can find that the majority of the building society's assets are including the residential mortgage. Traditionally, the building societies are owned by their members. Profit are accumulated rather than paid out in dividends, and represent a large portion of the capital of the society. And the main sources of income for the building societies are the interest income. Now in this slide you can see some selected building societies in Australia, their interest revenues as of 2009, interest expenditure, non-interest income, and the net profit. Now remember, these incomes or the numbers are in $1,000. So if you look, the net profit of the building societies are not that much, and as per the previous slide we have seen the size of the building societies are not growing at all, or the growth is insignificant. So what is the future of the building society? So the environment in which the building society operates is becoming increasingly competitive. Many factors, including a possible housing market decline and the population concentration, present a challenge for the future of the building societies. Not only that, in Australia, several building society they became bank or they merged with other large bank because of the increasing competition in the financial market and the mortgage market. So the second types of non-banking financial institutions includes here is the credit unions. Now if you go back to the history of the credit union, it originated in Germany around 1800. Credit union, like the building societies, are authorized deposit-taking institutions, are regulated primarily by APRA. However, the credit union first appeared in Australia around in 1940s. Credit unions are the credit cooperatives owned and operated by their members, and the credit union tend to focus on consumer lending rather than the residential mortgage, which is predominantly the product for the building society. This is also to note that the credit union are regulated by APRA in the same way that the banks are regulated. So let's look at the asset and liability side of the credit union. So the asset side of the credit union mainly on the loans of the members. So approximately 80% are the residential or the personal loan of their own members of the credit union, and the liability side consists of the members' savings account, which includes accounts payable, tax liability, and different types of other provisions. However, this is to note that the credit union do not hold shareholders' equity, and therefore capital consists mainly the retained earning for the credit union. And this slide shows the statement of the financial position of a typical credit union in Australia. However, I do not want to read this particular slide because you can look it by yourself, but this is a typical financial statement for a credit union. So we'll go to the next slide, which is about the finance companies. Now, as we discussed about the credit union and the building society, and we have some understanding of these two types of institution, but the finance companies are typically a different types of institution than the credit union and the building society. So companies that raise funds from the wholesale market and retail investors and then provide loans to household and small and the medium-sized enterprise are typically called the finance companies. However, this is to note that the finance companies are not authorized deposit-taking institution. Finance companies have more diverse interests than the building societies and the credit union, as we will see in our next slide that what are the different types of activities the building society can perform. Finance companies emerged as a way for banks to circumvent certain regulatory restrictions. And the finance companies are specialized in consumer finance, leasing, but they also deal with many other same types of product like this bank, building societies, and the credit unions. This slide will discuss about different types of finance companies. There are different categories of finance companies that we can see in the market, which includes captive sale finance companies, niche finance companies, debt consolidation companies, and diversified finance companies. So if you look each of them, the captive sale finance companies, the first one, which is the finance goods sold by the parent companies, for example BMW, Holden Financial Services. So these types of finance companies, they sell the product of their own parent companies. So the number two finance companies include the niche finance companies. So this includes companies that focus on the factoring, lease financing, and pay-to lending. The third type of finance companies are the debt consolidation companies. So these types of company, they consolidate debt of an individuals or even a small companies. And the fourth types of finance company includes diversified finance companies that offers a broad range of services, include credit card, personal loan, or car loans. So what are the assets of the finance companies? Finance companies tend to divide their activities into business and consumer lending. As such, loan and lease receivable makes up the majority of the finance company's assets. So for example, think about GE Finance. So GE Finance, they provide loan to their client. So the assets that can include the receivables. So the loan receivables or the lease receivables, this is the main types of asset which they can have in their balance sheet. The types of the receivable held by the finance companies could vary, greatly. For example, depending upon the activity the finance company is taking, their finance receivable types will also differ. G Capital, for example, makes all types of loan to all types of borrowers. However, other finance companies may be far more specialized in their activities. So the assets of the finance company can also include consumer receivables. So consumer receivables are the loan issued by finance companies to purchase of goods. For example, if you go to the Harvey Norman or Good Guys, and if you don't have any cash, so you can actually take a loan in that particular shop, whether it's Harvey Norman or the Good Guys, and take a loan instantly from the shop. And typically the shop will allow you to purchase the good without any deposit, because this product are financed by the G Finance. So for example, you can apply for a G credit card instantly in that shop or in that company. So in G Finance will give you the credit card, and that credit card will allow you to purchase a good from the shop. For example, you want to buy a TV. So this can include a personal loan, for example motor vehicle credit, revolving consumer installment credit, and miscellaneous consumer loan. It could also include the second mortgage. And the business credit for the finance companies can include the wholesale financing, retail financing, and the lease financing. So what is wholesale financing? So this involves helping a dealer finance the purchase of goods. One arrangement called the floor plan financing, which involves the finance company paying for the goods. For example, if you want to buy a car, and if you go to a car yard to purchase the car, you'll find that all cars which you want to buy are financed by a wholesale finance company. And typically, a sale of the car will not take place without the approval of the finance company. Though in that car yard, the owners are promoting the product, but the title of that car belongs to the finance company. So the product includes the cars which you want to buy, and this is a typical floor plan financing. So this is a wholesale financing. So there are also retail financing. So this involves the financing of goods used for the business purpose. For example, for your business purpose, you want to buy a van. So the finance company can finance to purchase of this vehicle for you, and this is called a typically retail financing because this instrument will be used for your industrial purpose. And the third part is called the lease financing for the finance companies. So lease finance involves the leasing of a durable goods for the business, and there are many advantages of lease finance. For example, tax advantages, protection of the ownership rights, and convenience and flexibility. For example, you want to lease a car for your business, so you can go to a finance company, and this finance company will allow you to lease a car and will pay for that. So what basically you will do, you will be paying a monthly installment for the lease. What are the liabilities and net worth of the finance companies? You have to understand that the finance companies, they raise funds from the market and they sell the product to the client. So the finance companies are highly leveraged company, and capital to asset ratio for the finance companies are typically from 10 to 25%. And the finance companies, they raise finance through issuing different types of commercial papers, debentures, and unsecured notes. Although finance companies that have a parent company may access transfer credit. Hopefully you like this lecture. Please subscribe to my YouTube channel to see my other lectures. Thank you.